Hi, welcome to the InterAxis channel and interaxis.io. If you're watching this on YouTube, please subscribe. We're going to talk today about using digital assets, cryptocurrency, this whole DeFi world to find yourself a little more yield if you're an investor, and just how we look at this. Okay, it's kind of a different spin on this, and we want to make sure we tell you, we're not talking about yield like the yield farming has done in DeFi, where people were making 100% or 150% returns on their money real quickly, but that was some of it was very unsafe, and some of those yields have been taken away. But we want to talk a little bit about utilizing some of the concepts here to find yourself more yield as an investor. So first we have to talk about what yield is, or what income looks like. Because if you have the typical, say, we'll call it the 70-30 or the 60-40 portfolio, what that generally means is you have 70% in some sort of growth or equity position, right? And this is where you just own stocks, essentially stocks, or usually ETFs or funds of stocks or something that represents ownership in a company, and you just hope the value goes up. Okay, I bought it at 100, I hope it goes up to 110. That's where I'm trying to get my growth. The 30 or the 40 here, this is some sort of income. Okay, and in the past, this was the role of bonds, right? You could have muni bonds that are essentially you're lending money. So this is a lot of times some sort of debt. I'm essentially lending money and I'm getting paid some sort of income. So the idea was, if this growth or equity, if this was going down or if this was flat, you always had dollars coming in the door because you had this income coming in. This was pretty steady. Okay, now the addition of this, the helpful part of this is, if you had long-term debt for several years and interest rates kept going down, the value of the instruments you held here actually went up, probably more so than the growth over here. Now, what you could also have over here is things like dividend-paying stocks. Right, so stocks or equities that would actually pay you a dividend. What we also find a lot of times in the 40 is things like real estate, because real estate you have to hold it, but it pays you usually some sort of income, some sort of distribution or dividend. Right. So now what happened is interest rates, as we know, have gone way down. They are at near zero, or in some cases negative. So everyone in the world is looking for more yield. Where can I put my money that it can sit there and earn me more money, where I don't always have to have some sort of growth or equity component, where I don't always have to just hope that the next person in line pays more for it than I did? Where can I put it where I can actually earn something on my money that's just sitting there? Because right now, on my dollars, if I put them in the bank, I'm earning nothing. If I put them in some sort of other investments, because of that, real estate doesn't have to pay as much income for people, because there's not as much of a hurdle rate. Because in the past, where if I could earn 5% on my money sitting at the bank, real estate would have to earn me like 10% because of the risk that I have to take. There's a risk premium here, there's a liquidity premium, right? If I'm going to put my money in a real estate for a long period of time and I can't get it out, I better be earning at least 10% on it, because it has to clear the 5% I can make by just sitting it in the bank, knowing that I could use it any time. Plus, there's the real estate risk, right? There's the risk that the value of that real estate goes way down. So if I'm going to be getting into things like this now, I know that for most traditional assets in the world, there is a very low interest, there's a very low yield. So what can I do? I got to find something else, because my risk now of getting too heavily in things like this is, one, the interest rate is so low. So my money is sitting there, it's not earning that much, but I also have somewhat of an inflation rate risk, right? Because if these are relatively long term, then, and they're paying me, $100 a month, well, in a year, that $100 is not going to be worth very much. It's not going to be worth nearly as much. So I have some inflation rate risk here as well. So this is what I have to look at as an investor, is where am I going to go find yield? So what I might want to do is delve a little bit, this is having to have some understanding, but where in the kind of digital asset cryptocurrency realm might I go to try to find a little more yield so that my money can do a little bit more for me? And it's really interesting, because of course you have to take on a little bit of this technology risk. But look, if I'm comfortable, say, we'll start off real basic. If I'm comfortable owning something like Bitcoin, right, I can go essentially lend out my Bitcoin, or I can get an interest account on my Bitcoin. So I'm comfortable owning or holding Bitcoin. I can go deposit it and earn interest, earn anywhere from 6 to 8%, and a lot of times that is paid in Bitcoin. Companies like Gemini and BlockFi are allowing me to do that. Okay, I can also take, if I'm not as comfortable with that, with the price of Bitcoin, because this obviously has some volatility to it, I can take USDC. USDC is US dollar coin. Every USDC token is backed by $1. There's $1 in the bank, audited every month, for every USDC. So I can go buy USDC and lend that out. And I might be able to get 3 to 6% on my USDC. And the only reason we have USDC is because now it's programmable money. I can use it in smart contracts and DeFi. And so a lot of the world is starting to use this. Visa's even integrating it now. So I can go someplace like Gemini, Coinbase, wherever, and buy USDC and just lend that out at a higher interest rate than I can just my dollars. Now I take on some technology risk, and I take on a little bit more risk because this is not FDIC insured anymore. So I go from FDIC insured sitting at my bank to not FDIC insured but earning more yield, and I have to have the technical ability to go, I'm going to move my money from where it is at the bank to something like Coinbase or Gemini or wherever, this USDC, and then lend it out. And I have to be comfortable with all of that from a technology perspective and from a risk perspective, but I'm earning a little bit more. So that's a place that we can look and find more yield. Now, going a step further, can I take this USDC or something like ETH, again, if I'm comfortable with it, and go into some DeFi platform, and I can provide liquidity, right? I can go earn even more on some of these protocols like Compound and Aave. Okay, and I can go earn even more on either my ETH or my USDC or some other token. And again, if it's something like USDC, I have I know that it's backed by $1. I know that it's worth $1. It's audited all the time. I can even go and provide liquidity on something like Curve using my USDC. And liquidity just means I'm providing my USDC into this pool so that others can trade it. And this is a way that we can do this in a decentralized way. And if you don't get this, we have some other videos that talk about the incentive mechanisms and automated market makers and such that are really important. So these are other ways that I might be able to find yield. Again, this sounds like it would be really complicated and complex, but you can probably get help from someone who understands it, and you are just now taking this, this inflation rate risk, or this inflation or this risk that you have of your money being worth less in the future than it is now, and you're going, I want to get more yield. What do I have to take on? I have to take on some technology risk. Okay, so here the risk is, potentially things like, what if these called smart contracts. What if these smart contracts get hacked? What if someone takes out the money? Well, then I can get insurance. Can I get insurance to cover that? So now I've paid a little bit to get insurance to protect my some of my technology risk, but I'm getting so much more income on my money that's just sitting there anyway. So as an investor, we have to start looking at things like this because this is going to be more popular. There are other ways we're seeing in the kind of the crypto tech world that if you're an investor, you might want to start getting involved in this, and if your advisor understands it, they're great to help, and if they don't, then contact us and we'll help them. But there's other things you can do, like staking. Okay, staking just means you take some cryptocurrency, some token that you have that allows for staking. That means their consensus algorithm involves proof of stake, and that means that you can contribute your tokens to the staking pool, and you will, potentially, and you can pretty much figure out algorithmically how much you're going to earn. So you contribute your token here, we'll call it SNX or something like that, which I don't think they're doing that anymore, but you can contribute your token to a staking pool, and we'll call it Tezos. So is a good one for staking. So you can contribute this to a staking pool, and you can get paid more of this. So you get more Tezos in this case, and you can go to a company like Staked or some others that can help you stake some of your cryptocurrency. So if you're just going to hold it anyway and you've identified some that are good for staking, you can go do so and actually earn more on those. If you like that token anyway and you're comfortable with it, you can just earn more of that particular token, and you're just earning income. It's like owning stock in Apple, and Apple continues to pay you more, gives you like a dividend using their stock. So if you get more Apple stock for owning Apple stock, that's what this is like. So I get more Tezos for owning Tezos and contributing it to the pool and staking it. So that's how that works. So staking is going to be more popular. It's going to get there, and you're just going to have to understand the technical part. So now you have some technical risk here because you have to understand this, you have to understand how it works, but you also potentially have some risk of the value of this token. If it goes way down, then you've lost some of that value, but you've made up for a little bit by the virtue of the fact that you now have more of them. Okay, so staking is another way. And the last one I'm going to talk a little bit about is mining. Right, because mining is something that I'll say I personally look at. I'm not advocating it for everyone, but it's something that I look at, and here's how I look at it. Look, you can do Bitcoin mining, which is prohibitively expensive now for most people to buy Bitcoin miners. But what it means is I pay my money, right, to buy the miner, and I pay for the electricity and the connection and everything else. And when I get coming out here is Bitcoin, and I probably get more leverage, like more ability to generate more Bitcoin. If I'm really sold on the fact that Bitcoin is going to at least stay where it is in value or go up, and I can take my money and use that to produce more Bitcoin rather than just buying Bitcoin, then from from a yield perspective, I'm able to get myself a little bit more money. Again, I'm not advocating anyone do this. I'm just trying to help you see how you can look at some of these crypto digital assets and the incentive structures that they're creating as more ability to create more yield and more income in your life. Another one that I'll talk about that I do, and this is just because I have experience with it, is one called Helium, where you buy these little devices. You buy these devices, you connect them to your home Wi-Fi or your office Wi-Fi, you plug them in, and basically they connect to each other and create what's called a long-fi system, a long-fi network, and others are using that network for things like GPS tracking and such, and it costs them a lot less. Well, you are helping to create and keep that network safe, and by virtue of the fact you get HNT, helium tokens, which have some sort of value. So I might have paid a certain amount of money for this, and I calculate, here's how much HNT it's producing for me every week or every month, and can I go sell that and use that to pay for parts of my life? So if I put $500 in here and it's giving me $1,000 a year, that's relatively good value. So instead of looking at investing all the time as how am I going to just put money in some sort of asset and hope it goes up, it's how can I put money in something that generates more of an asset for me, and look at how that income funds my life. Does it fund some part of my life? Does it fund private school? Does it fund my retirement plan? Does it fund my car? Like, how many things can I fund by investing in some asset that produces more of another asset for me? And that's what yield really is when you think about it. It's how can I invest my money to produce more of some sort of asset that I need, or more money that I need? And can I leverage that better than just investing it in some asset that I hope goes up in value? Do I have more control over this? So I just wanted to have this little talk about how we're thinking now about yield and income, and how it's different now with digital assets, with cryptocurrency, with blockchain. There are different ways to earn income or earn yield, and we're just going to have to look at the different risks that we're creating, the different risks that we have now in the traditional world and in our traditional method of thinking about finances and our personal finances, versus what we can offset. We can offset some of those risks, and we're going to take on some others. And are we comfortable with that? And at what point are we going to be comfortable enough to go, you know what, I'm going to put more of my assets to work for me, to earn more income or earn more yield for me in kind of this decentralized finance way. I need to get over the hurdle of the technology risk, and once I do that, I can earn so much more of my money, and I can provide more opportunity, and it opens up the financial system for me. So that's a little bit about uncovering or using digital assets or cryptocurrency or DeFi to find a little bit more yield with the money that you have.